All right, we're live. Itamar, thank you so much for joining us.
Ben, thank you for having me. It's so good to see you again, buddy. It's been a while. And Marc, thank you for having me on the show.
Yeah, it's so excited for this.
Those who listened to our episode around how we got our first tech jobs could look back and hear the story about the M3 that I drove from San Francisco to Austin to ultimately land a job at Life 360 in a very roundabout way. And the person that I mentioned that I met on that Friday afternoon who asked me if I was going to cancel my flight to drive this car to Austin is Itamar. So that's we've had Chris on the podcast, Chris Holes, but we haven't heard from you yet on the podcast yet, Itamar. So
full circle.
Is that a true story? Can you confirm that actually happened?
It is a true and crazy story. Somebody introduced me to Ben. I don't even remember who it was. And he was just visiting from Miami, thinking about maybe, finding a job in Silicon Valley. And I just met Ben and he seemed great. He seemed like a really awesome guy. And I was like, oh, wait, I mean, we're a startup. We're hiring people. We need help. And right about that time, we had this big event coming up at South by with BMW. And we're like, big splash and like launching our new product and technology that we've done with BMW. And we had an M3 sitting there. Oh, sorry. We were
actually, you hadn't bought it yet.
Yeah, we haven't bought it yet. We're like, okay, we need a BMW M3 because obviously we're all car people. We love cars. Then we needed somebody to drive it. So I was like, wait. And I was talking to Chris Hose, who was also on the show, as you guys mentioned. It's like, wait, this guy, he is looking for a job. He has some free time. Maybe he can drive our M3 to South by. So we ended up, after just meeting Ben, going to a car dealership, getting a $6,000 car together, then giving it to Ben, who didn't know how to drive stick. I hope that's not too embarrassing for you, Ben.
No, we talked about that. I take that as a badge of honor that I was able to pull this off, not knowing how to drive stick.
I mean, it is a badge of honor, man. Like you learn how to drive stick in a weekend, and then you drove all the way from SF to Austin on a stick, and you did a really good job. I was like, wow.
Yeah, also an M3 is not an easy car to drive. It has a lot of power to it. But you just gave that vibe of, hey, this guy looks like he can drive an M3 and we'll get it done.
We'll get it done. And then we spent the week, hanging out with Ben and you could drive the car and he helped us with the show and all that stuff. And the end I was like, this seems like a smart kid. Maybe I'll just hire him for my product team. And that's what happened. End up hiring Ben as a kind of I think it was your first job doing
like
product,
a project
right?
manager. I was a project manager on the, I guess, like customer support team working with, technically, I think you were my skip manager. We had one person between us who was managing me.
That's right.
And then
you moved over you were directly under me at some point, weren't you?
Correct. I was under you at some point.
With product.
And then,
when I was running product. Yeah.
And then I left. Yeah, you were managing me for a period. Very hands-off manager, I would say, like one of my favorite style of manager. No, but yeah, you had a really interesting journey, I think, at Life 360. When I met you, I think the VP of product was your title at that point. And I think your story at that time was that you had made the switch from the dark side, the VC side, into the operating side. And I think you had enough invested in Life 360. You're like, I'm going to go in and actually make this thing worth more. And you came in and spent over a decade. How long were you involved at Life 360?
I was advising Life 360 up until the start of this year. So I was there from mid 2012 all the way to the end of 2024. That's 12 and a half years.
Wow. Yeah. Great. It was an incredible run. And I think when I left, you had moved over to Chief Business Officer, I think was the title that I think you had at that point. And then all along, and somewhere along that process, you decided you wanted to stay a VC. You didn't want to stop investing. You wanted to operate and invest. So were you investing that whole time kind of like on the side? And then when you decided to leave Life 360, you decided to make it your full-time thing?
Yeah, totally. I mean, it's not something that we talked about a lot inside the company, but I was doing angel checks. Well, I joined Life 360 in 2012. So I was doing angel checks in the beginning while I was at Life 360. And I already had a bunch of portfolio companies because I came from venture and I started an accelerator called Upwest Labs with a few folks. I was there early, helping them kind of spin that accelerator up. So I was already doing a lot of deals, mostly as an angel. But then in 2014, and I think this is maybe before we even hired you, Ben.
Early 2014 is when I joined. Yeah.
Yeah. So in 2014, I've already set up Recursive Ventures 1, which was my first angel fund and a predecessor to Recursive Ventures 3 that I run today. So I was running Fund 1 and Fund 2, which are 2014, 2018 vintage, were both funds that I was running while I was doing full-time work at Life360.
Guys, so you have, I guess, what, like how many years of 15 years of investing experience, 16 years of investing experience at this point?
Yeah, I mean, if you look at the bigger picture, I've been in startups for my entire career, which is 25 years. I'm a repeat entrepreneur and startup executive. So I was part of 2 big exits early on, right? I was at Life360 very early on, and then, I bought out a co-founder, which made it an even bigger all-in bet on the thing. And that obviously went public. It's now a 6, 7, 8 billion, whatever market cap company. I was also, and this is potentially relevant to our conversation, I was also head of product at a company called Gigia, which was an enterprise B2B early SaaS player that was sold to SAP for $350 million. I was employee number 2 and product manager number 1. And then I built a product team to be head of product. So I actually have a rare experience of, well, other than the engineering background, which I had before, of both being a product leader in B2B and being a product leader in B2C before moving over, completed the business side and becoming a VC. As an investor, I've been investing for 15 years. I have over 150 portfolio companies, and 8 of them are decacorns and unicorns at this point. And I'm very early in all of them, typically the first investor or one of the first investors. So for me, it's coming like full cycle. Like I've built these companies again, both on the B2B side and on the B2C side. And I've been investing, and now I'm really focused just on investing and supporting founders as they move, as they start their companies and kind of at the inception stage, right? From 0 to 1.
Yeah. And that's such a powerful story as a VC of probably your most valuable thing that you had early on in your career was probably your time. And you chose that very wisely, right? Like you had 2 early exits as an employee. So I think that probably also supported that kind of journey into venture too, which is really cool.
Yeah, no, I agree 100%. I started my career as an investor on Sand Hill Road. And the first thing that the partners there told me is if you haven't built a big company, you shouldn't be a VC because you don't have the credibility. Now, that is, a lot of people debate that. I'm not saying that's the only approach, right? But that's what I believe in, right? I don't believe I have the right to support founders at the earliest stages if I haven't walked in their shoes.
Yeah, what's funny is the day I met you at Life360 that Friday, I came up from Sand Hill Road. I had 4 or 5 meetings on Sand Hill Road that week because I was thinking about going in the VC route, and I met with 10 different people that week. And the advice I got was exactly what you said. Everyone's like, you're a kid, go get some experience. And if you want to do investing later, once you have operator experience, maybe you can come back to it, but go do the actual building thing first. So I think that advice is something that steered me to an operations role. And obviously we didn't close any optionality to do investing by doing that.
Yeah, I think that's the right move for most professionals. But hey, there's outliers out there who they have 0 experience, they start a VC fund and they hit gold, and you can also be successful that way. But again, I'm more old school. And when I think about what it takes to be a VC, I just think about as a founder, what is the VC that I would want to have on my side, right? And that's what I try to be for my founders.
Yeah. So a lot of the people that follow us on this podcast are product leaders. They could be senior ICPMs, VPs of product, directors of product, people that have been in your shoes in your product operations days. Some of them are already founders or thinking about starting a company. And, one thing we wanted to dig into, I think, in this conversation with you is really around the way that you evaluate a moat when it comes to a startup, and why you want to be able to see some kind of potential for a moat in some of these early startups that you invest in. And we've had people some Gokul, for example, when we had him on the podcast, doesn't really care that much about moat in the beginning, and he wants to just know later, once there's something to protect, that there's an ability to set up a moat, but it's not the first thing he worries about in the beginning. But I think you might think of it a little earlier than that. So yeah, could you just walk us through your current mental model for the importance of a moat in the very early stages? Because you come in pre-seed, you're super, super early in there.
That's right. I do pre-seed and seed, so I'm super early. I'm in lead inception check, if you will, institutional inception check, but still inception. Let's start by establishing why this moat thing even matters, right? Before we dive into what's a moat, how does it look, and especially what's happening with moats now in the age of AI is everything is transforming super fast. So we should talk about that. But the reason I like thinking about what is the moat for this business, even if it's very early on, is because I know from experience of investing and building companies that if you don't have some defendability, if you don't have some edge, if you can't explain to me as a CEO founder, as a founding team, why you are ahead of the competition today, today, like why are you 1 year ahead of the competition today or more? And why you're going to be ahead of the competition 5 years from now, I think we're going to have a problem. And the problem we might have is twofold. First of all, if you hit gold, you build a startup and you're first to market and you're doing great and you just hit it out of the park, everybody knows. And then you're going to find, especially now in the age of generative AI, you're going to find 20 clones breathing down your neck overnight. And if it ends up that you don't have a moat, you don't have defendability, and each one of those 20 new entrants to the category can grab a little bit of your market share, then you're not going to have a significant market share at the end of this journey. And you're going to be marginalized. Your profit margins are going to drop. And that doesn't end up with a multi-billion-dollar liquidity story, right? So that's the first thing. The second thing is, and this is also very much true in the age of AI, is think about all these incumbents, which have, they already have the relationships with customers. They have the data, which is very, very powerful. They have the bandwidth. They have the capital to create AI, automation, so on and so forth. So again, if you just have a great idea, but you can't protect it, you don't have the moat, the big guys are going to come after you and they're going to blow you out of the water, right? So really what I've found over the years is the companies that do build a moat, and there's a lot of different moats that we can talk about, but build a moat around their business, they're the ones that go all the way. And if you don't have the moat, I think the music might stop somewhere. It could stop at the seed, it could stop at the Series B, or it could stop when you're a public company, but it will stop at some point. You'll get commoditized, your margins are going to go lower, it's going to be hyper competitive, and it's not going to be as lucrative as a business. And that's why I think, and I encourage my founders to think about a moat even as early as inception.
I think I can picture like what a good answer looks like for like, let's say like, what is your moat and how are you going to stay ahead 5 years from now? But when it's so early, pre-seed, like what are some acceptable answers in your point of view of what a moat might look like at that point? Maybe it's like, you don't have that many customers and
yeah.
Like that. Yeah.
So let's talk about it. And let's talk about first pre-generative AI, and then we can talk about generative AI, because which introduced a lot of differences with how we think about the moats and defendability in the generative AI age. So actually, let me get a little bit philosophical here. Just think about the tech wave that started in around 2009, 2010, after the great financial crisis, leading all the way to 2021, 2022, just before generative AI was introduced. That big tech wave, which changed the world, was actually driven by business model moats. Okay? Think about the big companies that came out of that era. Uber. Why is Uber so successful? Uber is so successful because it has a business model innovation piece where they locked up supply in a marketplace and created a huge moat around it. Uber is actually a moat play. Think about it. If you want to try to compete with Uber, and if you're Lyft, you have scale, so you can, but let's say you're a new entrant and you're trying to enter Uber's category as is, you're just going to be locked out of the game. There's no way, right? They have all the drivers, they got the scale, they got the demand and the supply. It's a marketplace. So marketplace is a great example of a moat. It's a classic moat. Let's go to the next one. Let's think more broadly about cloud. Cloud was a very big piece of that big tech wave that we're talking about, 2010 to 2022. Cloud, SaaS. What is cloud essentially? Cloud is just, again, business model innovation, enabling B2B companies to deliver continuous deployment of software and continuous improvement of that software, right? And the companies who won that SaaS race are the companies that leverage the cloud to ship fastest, most accurately, and exactly what their customers want. That creates a moat, because if you have an organization that just knows how to ship super fast over cloud, all your customers get the next version tomorrow, right, today, then the customers just stick with you, right? And the incumbent or the new entrant that comes in, they can move as fast. They can deploy as fast over the cloud, and they lose. so you have a moat, right? So that's another example.
Mm.
And the last example I would give, which is a classic example that everybody knows, is network effects. Network effects are inherently moats as well. A lot of people talk about virality, like think the Facebook style of like, oh, I invite like all my friends, they come in and the graph grows very quickly. But not a lot of people talk about the lock-in effect that networks have, right? If I have all my friends, and I'm old school, so obviously I use Facebook like all the 40-year-olds, but like if I have all my friends on Facebook, and I do, right, then the switching cost for me to switch over to a new social network is actually really high because I got to migrate all my friends over to have the same graph. That is a network effect driven lock-in effect. That is a moat, right? So those are just like three simple examples of moats that we have pre-generative AI age, which what's the result of those moats? Guess what? $1 trillion businesses, because they have such a big piece of the market, right? Their market share is massive. You can't challenge their operating margins because they're the only game in town, right? And it's almost like these moats, they create monopolies. And obviously that's not a great thing for our society, but it's a great thing for business.
You want to build a monopoly business. I mean, that's the ultimate way you win, right? Now, if you get big enough that you get subject to like antitrust, litigation or whatever, you won, right?
You won.
Yeah.
I want my companies to come to me and say, look, the regulators are now chasing down our neck because we're so successful and breathing down our neck. It's like, yeah, well, at that point you have enough money to handle all that stuff and you hire the lawyers and you figure it out. But,
so if like establishing a monopoly is almost like the VC's ultimate like goal, every company you invest, basically building like every company you back, building some kind of meaningful monopoly in a large market, then working backwards to, and let's say that takes 10 years because it's not going to happen fast, right? Like this stuff takes time. So working backwards from that to like literally writing the first check or like one of the first checks, you view a moat, or at least a story about the ability to develop a moat as a proxy, maybe like a leading indicator of potential monopolistic attributes.
100% correct. And the reason why that's important is because of the VC power law that everybody talks about and everybody thinks about, but you have to really live by that law and implement it. My fund does 30 to 40 pre-seed bets in each fund. And each one of those bets, what I'm trying to do is I'm trying to find a thing that has a very, very low probability of success. Let's be clear, very, very low probability of success. But if it is successful, it owns the category it plays in as by far the market leader, right? And it locks in that market, as much of it as it can, and then it's worth multi-billion-dollar, right? It's a multi-billion-dollar business. And the reality is in my funds, I just need one or two of these, right? So I naturally gravitate toward those big swings that have a moat with the low probability of them working out. But if it does work out, it makes the entire fund. And that is the model. That is the model for pre-seed VCs. That power law is on steroids for pre-seed and seed VCs. And that the moat piece perfectly plays into that dynamics.
Yeah, I definitely want to get at some point how AI is changing that power law and maybe like, how far you can get to maybe like revenue and maybe like, the seed strapping movement that we're seeing too. But before we do that, I do want to hang out in this like moat space a little bit more. Like, let's say I'm a founder and I tell you, hey, here's how I'm going to build a monopoly, and here's my genius plan for creating network effects or whatever of those moats that existed before, that exist today. But what are some early signals that you need to see for you to have the confidence that I actually will be able to execute and that I have something unique or special that will make me successful?
Well, look, this kind of goes back a little bit to investment criteria for us at Recursive Ventures. I would say we're very, very focused on team, time, and moat. So on team, we're definitely looking for people that have proven execution to some degree. I mean, you could be young, but like you build stuff and you show it to us. We're like, yeah, this team knows how to build. So we want to make sure that you can execute, because from our standpoint, it's like there's so much risk building startups of like market and trends and competition and capitalization and cycle, where you are in the cycle, all those risks that we can't control. But the one risk that we can control is making sure that we got a team that knows how to execute, that knows how to build, and knows how to build quality stuff. So that is a big, piece that we look for. Another piece that we look for is completeness. Do we have the right DNA in this company? Like, okay, you're doing a consumer product. You want to have Ben, because Ben has experience building, consumer products, and he knows what he's doing, right? So do we have all the right DNA pieces that we need that are critical to the success of this company is another thing that we look at. We spend a lot of time trying to think and challenge founders on resilience. Are you going to stick to it? Are you now paying people out of your own pocket? Like, you believe in your vision more than anybody out there, right? That's kind of that conviction. We want to see that early on. So those are some of the bigger components in the team side of things. On the TAM, which is a very important point a lot of founders miss, is like, don't get VC money unless you're building a business that can get super, super, super big. That has a huge bottoms-up TAM that you can achieve, because otherwise you're not going to be aligned with your VCs. You're not really on the VC path, so avoid doing that. And then the last piece is the moat piece that we talked about. And when we think about evaluating this, sort of going to your question, we ask for tangible things where we can. And especially in AI, if we talk more about AI, it's really a lot of data stuff. So we actually ask founders to show us the data, right? Show us the data, walk us through the data. And that gives us a lot of kind of color around, okay, how does the quality of this data translate to a better AI system? And I think this is a great segue to talk about moats in the age of AI.
Yeah, let's do it.
Let's do it.
What's changing? Like, what's still true and maybe what's different?
Okay, so let's start with the big changes that are actually pretty negative for founders. And that is the fact that vibe coding is eating up engineering, eating up the world, right? So just think about where we are with vibe coding today. We're just getting started. It's pretty clear that 5 years from now, anybody can build anything pretty quickly and pretty effectively as long as they're smart and they know what they're doing. Okay?
That's
It's
definitely
pretty
where
clear
this
that
is
this is
going.
where we're
Yeah.
going, which means that the bar to compete with your next company, Ben, has just gone from here down to nothing. That means if you're onto something, there's going to be 50 people chasing you next day, right? And the bar to go in and compete with you is going to be really, really, really low. That's freaking scary, because a lot of what we used to do in the past as VCs and entrepreneurs is we would raise enough money to build a big enough system. So it's so hard to compete with us. It takes a lot of time to build the same thing and yada, yada, yada. Now you can build anything you want overnight. So the barrier of entry has significantly decreased, and it's freaking scary, guys. It's scary. You can have a winner and next day, bam, it's copycat 10 times. So
Do you think there's someone who's who sees that reality and they're actually the opposite, super excited that's true? They're oh, this is my moment to shine? Because you know what I'm saying? Is there some people that are okay, this is a huge advantage for me?
Oh, absolutely. You know who? Your community, product people. Product people were highly dependent on engineering to get their products out there. And I think that's going to change, guys. I think that's going to change big time. I think you're going to have product people just building their products, right, directly. And maybe engineers going to help them with deployment and quality, but they'll figure out the whole product by themselves. These smaller products initially, and then eventually even bigger products. I think this is the most exciting time to be a product manager, because you can actually realize your vision, your product vision, without having all these dependencies. It's huge.
I'm curious what how far in the future are you living on a day-to-day basis? Because in order for you to be an effective investor, and knowing how long it takes for these investments to become worth anything, are you basically spending a bunch of your time imagining what the world is like in 3 to 5 years and trying to only make investments today that how far in the future are you thinking about?
I have a write-up somewhere with multiple versions of what I think the future would look like 10 years from now. And the reason I care about 10 years is because that is a cycle of a typical VC fund. I'm seriously, how would the world look at 2035? I can give you my bets on that, but I don't know if that's the purpose of this show. We want to talk more about product and moats and stuff like that. But yes, yeah. And I try to also create a journey between you just heard one of my first ones, which was like, everybody's going to be a coder. Everybody's going to build whatever product they want. I think that's going to be reality 10 years from now. So now I'm tracking against that. Is it going to take 5 years? Is it going to take 20 years? Is it actually working? Are product people actually like building products independently? And I think we're off to a slow start, but I think it's around the corner. I think it's happening. And I do have buddies who are more technical PMs who are like, yeah, we're just doing stuff ourselves now. We went to our prospective teams. It was like, yeah, me as a PM on this team, I'm building this feature now. I'm seeing that starting to happen.
Yeah. Is another one smaller team sizes or companies? Like in 5 years, like the typical like $1 billion VC backed company has like an order of magnitude less people than it has for the last 10 years? Like, is that another?
It's already happening. It's already happening in my portfolio. I already have my best CTOs calling me up and saying, Itamar, we're not going to hire the number of people that we thought we were going to hire because we have 5 engineers who are like amazing. And we think we can do much more with less. And look, if you look at this Base 44 story, obviously an early acquisition by Weeks. I mean, this one guy built like a level, it's a huge success. And I think we're going to see more and bigger ones. There's the sexy, this one guy built, or this one girl built, $1 billion business. I think that's more of a cliche. What I think you will see is you'll see more of like the 10, 20, 50 people teams building unicorns. I think that is absolutely a reality. It's actually already a reality now. There are a couple of lists that you can track of people, like of companies that are sub 50 employees who are unicorns. There's like 20 something of them.
Does that change like the venture math? Like in a world where that's true, like how does that change things?
Best question.
Smaller company sizes.
Best question of the day. Venture absolutely has to transform to accommodate this new setup. And there are multiple trends happening at the same time, breaking traditional venture in a crazy way. Between seed strapping, right? And companies needing significantly less capital to get to scale because of these AI tools. And it's not just vibe coding, guys. It's like vibe coding and vibe sales and vibe product management and vibe whatever, right? Suddenly you get this productivity boost of like 2x to 10x in every single department, if you will, of a tech company, right? And what does that mean? That means that if you're Andreessen Horowitz, you're looking at this, you're saying, oh, fuck. What am I going to do with the $7 billion I just raised? My companies don't need all that money. And it's going to break a lot of the traditional venture model. And I think it actually is the best time because of that to be a seed VC. Because the check that I write, pre-seed, seed, I write the check that helps you quit Google, DeepMind to start your company, right? That gives you confidence that you can hire your first engineer. And that check, I think, is not going to go away because it's a leap of faith check. Okay. And is this real? And then all this later stage capital, Series A, Series B, Series C, where we used to like, oh, it's a Series B. Let's give them $50 million. Like, guys, they don't need $50 million. They're 20 people. They're already running $100 million of ARR. There's no point of throwing all that capital in. It's actually inefficient, right? Than letting them grow with less capital and having such a high margin business from the get-go. And I think, yes, that absolutely breaks traditional venture, and venture will have to rewire itself, which is very, very hard for venture because it's such a slow moving business, the way the funds work.
Yeah. And I'm guessing also just the pre-seed is going to get way more competitive because all these companies are going to realize, hey, that's where actually the opportunity is. So that's like another change that's probably going to happen.
But pre-seed has been competitive for a while. Look, pre-seed is like what seed used to be a decade ago. It's always been competitive. It's always, they're like, I've heard, I think it was 2,500 pre-seed stage VCs in the US. That's competitive, guys. Like, I got a lot of competition. Trust me, I know. But as always, the question is like, are you actually like adding value? Are you at a point where you can add value at the pre-seed stage? And I think the reality is, yeah, there's a lot of pre-seed managers out there because the entry bar is like, it's really easy. Just raise $5 million and you can be a pre-seed VC. But I think a lot of those folks are just going to fail because they don't have. So
like let's pull the thread on that. So like let's imagine again. Let's stick with the example of a product leader who's listening to this. Maybe they have something that's getting traction. They have conviction. They think it has monopolistic potential vis-a-vis some moats that they can tell a really good story around. And let's also say very well connected and can choose from like 30 different people to get that first check from.
Yeah.
What would you say to that person having kind of been that first check, but also probably seen some of these companies go with a different person for the first check and have them come back and be like, I made a huge mistake. Like that was not something I should have done. What would you say are like what's a good heuristic maybe for that person to figure out who to take the money from, that first check from?
Yeah, no, that's a great question. First of all, I would probably be a big proponent of don't take just a single check, because you never know who's going to help you. And I'll give you an extreme version of this, right? One of my companies, a company called Safecraft, I'm one of the first investors in. The founder there went and raised money from 200 different angels for their pre-seed round.
Wow. Wasn't that Oren?
Mm-hmm.
And wasn't he incubating that from the same building that Life 360 was in?
We subleased our office to
Oren. Okay.
And
but isn't he the co-founder of LiveRamp?
He was the CEO, co-founder of LiveRamp originally.
Okay, right.
Before he sold it and before it actually became a bigger company under the acquirer. So Oren, what he did is he went and raised money from 200 different people, because he was like, oh, all those people are in different industries, and they're all going to help me build Safecraft, right? Because obviously, if they wrote an angel check, they're committed to growing their money, right? So that's kind of on the extreme side of things. I'm giving that as an example of like why you want to have all those kind of raving fans who really are like rooting for you to win. Basically building a community of people, advisors, mentors, angel investors who can help you. So that would be the first consideration. And the thing there is like, you don't know who's actually going to be the person that comes through when you need help. Let's say you want to get to a specific client or you want help with fundraising, who can make the most intros. People talk, but you don't know who's actually going to deliver. So cast a wide net, take money from 10, 20, 30 people. And in every single case, you'll probably find one or two or three of them that will actually be able to help you with that single problem. So that's one heuristics to think about. The second thing to think about is, kind of like who can help you to raise the next round. I think that's really important. If you're on the venture track, right? If you're building a venture-backed company, that means you are, unfortunately, undeniably, in the pre-seed, the seed, the Series A, the Series B, right? You move up, the business grows, and it gets financing at the same time. So, for example, what we do at Recursive Ventures is we specialize. Our superpower is getting you funded in your next round with the best VCs possible, right? And that's an important value add, because if you have tier one VCs working with you to get more tier one VCs, that creates more signal for more tier one VCs. And you just end up with the best investors out there who can guide your company, land more clients, send out a stronger signal, a validation signal, even for clients that they should buy you. Yes, if you are Sequoia backed and you go to client N+1 and you tell them you're Sequoia backed, they'll take you more seriously. It's a reality. So
what you're saying, just to make sure like the people listening, I think this is what you're saying, is from seed or pre-seed to seed to Series A to Series B, basically investors generally specialize in stages. Some funds, large funds, might be cross stage, but what I'm hearing is like the best investors, in your view at least, are the ones that will set you up for the most success, are ones that not only are very good at identifying the best people for their stage, but then while they're doing that, they're building out relationships with the next stage of investors, so that they're building out that happy path for their most successful companies to go ahead and get those very high quality like investors warmed up.
And tier one investors. So I'll give you an example. Again, I've been doing it for 15 years, so this is a lot. I've helped over 50 of my companies raise a seed or Series A, and my interests have directly resulted in over $500 million raised by my companies from my intros. Not how much they raise in general. It's like, Itamar introduced me to this GP and he put a $10 million check 50 times, like stuff like that, right? And a lot of these were tier one checks, right? Like Andreessen and Excel, and the list goes on and on. That is kind of the second heuristics. The first heuristics we talked about is you want to have a bunch of people rooting for you. Don't go for one, go for a mix. That's the first heuristics. The second heuristics, I'm trying to answer your original question, right?
No, that's good. Keep going. Yeah.
Tier one investors at the stage that you're at, so you can get to tier one investors in the next stage, right? That's the second part. And the third part is, I just say, roughly categorizing VCs and investors in general, there's three kinds, right? There's the folks that truly help, know how to help, are good listening, sounding boards to what you're doing, probably have walked in your shoes. They've been founders before. They know the ups and downs. They can be there for you. This is the first kind. The second kind, which is actually where a lot of VCs fall to, that bucket, is like, do no harm, actually do no good either. They're just capital, right? They give you money and then they get out of the way, which is not too bad, by the way. Sometimes that's what you need. You don't need everybody helping you with everything, right? And the third kind, which unfortunately exists, and I write a lot about that in my LinkedIn posts, if you're following that, is those VC horror stories. This is all the VCs that know how to run your business better than you.
Those posts are bangers, by the way.
Should not know how to run your business better than you.
Your post about the anti-patterns, about bad or destructive VCs are incredible posts, and people should definitely go read your stuff. I think they get a lot of traction. I think they resonate because I think you say things not a lot of people say out in the open. You're revealing things that are like honestly like bad behaviors that people should stop doing.
Absolutely. We call those VC horror stories. And gosh, there's so many of them. And yes, I would encourage the viewers here to go out and listen to them if you're building a company, because yes, there are actually quite a few ways that VCs can screw up your company. And a lot of them are avoidable, right? So if you do the right thing, and look, it's almost like unfair because then the entrepreneur, the founder, like you play the startup game once. I played 100 times a year. Like it's completely different. Like that's my day-to-day is dealing with all this stuff. So yes, I wouldn't encourage people to read it. But that third kind of VCs or investors is like people that basically are detracting, right? They're either taking energy away from you where they shouldn't, or they're just like coming in and they think they can run your business better than you. So the third heuristics on how to pick your kind of team of investors would be, don't pick the bad guys. And the best way to do that is especially if it's a significant investor, just pick up the phone and back channel them once or twice. And the trick is, don't back channel them with existing portfolio companies that are doing great, because then you'll only hear good stuff. Back channel them with a company that went under and see how they behaved when push comes to shove or when the company is with its back against the wall. That's when the true character of those VCs really shines through.
If you're enjoying this conversation, please check out the links in the show notes to support the podcast. Marc and I do this out of love, but to keep it going, we also need your support. Thanks, and now back to the episode.
What do the good VCs do when a company goes under?
First of all, the good VCs do what they're supposed to do, which is be a fiduciary, which make sure that employees get what they're owed, that vendors, debt is paid. That requires an orderly shutdown. That requires shutting down on time to make sure that you are a good fiduciary. So that's table stakes. But to be clear, there's VCs that are not even good at that, and they should get sued, but whatever. Beyond that, I think the good VCs at that point in time, they recognize that there is no upside here. And really what you can do together with the founder is minimize downside for the team, for the founders and the team. So for example, if you've hit the end of the road, it's better to let go and get this company acqui-hired. So at least the founders and the employees find a good home. They get paid for their hard work. Maybe you get some money back, maybe you don't, but that's actually moved the needle for you as a VC, right? And recognizing that and actually supporting the team and making that transition and getting acqui-hired is actually one characteristic of a great VC.
Got it. So trying to find a soft landing of some kind that is not, call it a complete loss in everyone's book. There's a way to kind of position it as something that's still not a VC-backed win by any stretch, but at least for like the team that chose to like follow this founder, and at least they're not going to be left scrambling like next week with no job or something.
Exactly, because that's the worst case scenario. I mean, at the end of the day, good VCs want to take care of people, and that's what good VCs do.
I think that's also like a good
just people,
not necessarily a win, but like you save face as he had an exit situation, which I think in the career, if you look at it, it's probably better than nothing. I'm curious, what are some things that founders can do because for example, like the extreme example of someone getting 200 angel investors, like I'm sure like how much value you get out of those investors also depends on what the founder does to get the help at the right time. So for maybe the people that are able to get, most of your help, or you've been able to be most helpful, like what are some traits that they do to get you involved at the right time? and leverage the expertise that you have?
Well, I'd say, building a company is building a community. You have a community of investors and advisors and employees, and actually clients are part of your community, especially as you grow and they love your brand and they engage. So they're part of your community. So all the typical, and Marc, you're an expert in this. You build this amazing product community, right? Product manager, senior product manager community that you have at Supra. So like these same rules apply of like, what do you want in a community? You want high engagement. So for example, and it's funny, I think I saw somebody wrote about that, the frequency and quality of CEO founder updates to their, investors and supporters and advisors is actually a pretty good leading indicator to the company's success. A bunch of people wrote about it. I don't know if there's like actual science behind this, but anecdotally, it feels right to me because what those people are creating, they're creating engagement, right? And if you send, and I don't think you necessarily have to do a monthly newsletter, right? To all your fans out there, all of your community, right? And you have asks, right? At the bottom, you're like, oh, we need intros to this, or we are looking for a growth expert, or whatever you need, whatever your business needs today. I think that's how you get engagement. And that's how you make the most out of building that community of, angels and advisors and et cetera, et cetera. So build your community.
Every time someone helps you, they get more invested in your story, right? Like they feel like they're contributing to something. And I think it's just basic human nature, right? Like if I help you with something, especially if it's something in order to help you, I have to put my reputation on the line and ask someone to like do me a favor by helping you. Now I'm going to look better if you're successful, right? So like I become invested in your success. Does that feel fair?
Absolutely. I mean, creating a startup is a little bit like creating a movement. Yeah. You want to have as many people bought in to color themselves with your colors, right? It's like, oh, I'm a huge fan of this brand. Oh, I invested. I'm one of the first angel investors. And then they rave about you in every conference, at every event. That's exactly what you want. The more of that you get, the better off you'll be.
And that's a type of moat too, right? Kind of going back to that a little, is like the love that you have from a community. Like if you have a community around what you're building, that feels like a moat.
I mean, that is an actual moat in my list of moats in AI, just so you know, because what's going on in AI now, in generative AI specifically, is that there's a huge trend for open source solutions and communities around open source. And if, for example, you have, and I have companies who do stuff like that. I can give you like concrete examples of companies who have built communities of data scientists who are all dedicated to solving a problem, like a certain problem. If you have that community, it's actually working for you, then yeah, you have a moat.
So going back to our listener, right? So we've talked about how don't necessarily take one check, get as many, maybe not as many checks as you can get, but as many checks from the right people that will be helpful as you can get upfront. Ideally, those people have some kind of track record of being able to help you advance to top tier investors in the next stage. What are there any other characteristics? They're not going to be detractors. They'll be neutral or helpful. Anything else that you would kind of say to look for in those initial
founders? Look for founders. Simple reason.
People with specifically ex-founders.
Been in your shoes. They probably can relate most to what you're going through. And when you think about fundraising again in the next stage, guess who I get my best intros from? Founders that I've backed, who are either starting their next company or are calling me up saying, Itamar, my star employee from my previous company is starting their company and I thought you should talk to them. Those are the best warm introductions I get in my fund.
Yeah. Do you have any, sorry, just one last question here is like, do you have any, if someone's like listening and they're trying to figure out just like how much they should raise in that first round, like not to get into numbers specifically, but do you have any heuristics for figuring out just like how to figure out how much is the right amount?
Yeah, sure. I mean, there's calibration, built-in calibration in the market because it's a sophisticated market with supply and demand. The first thing I would try to understand, and I hit the categorization, is like, what stage am I at, right, with this business, right? And there's like typically let's call it, there's the pre-institutional stage. We typically call it friends and family, where like, oh, I just need 200K to build a demo. Okay. That stuff, you don't need a lot of money. You typically don't go to VCs for that. You're just like trying to show that there's something here, right? And then what we see today in the market is like your first institutional round is what's called pre-seed, which again is what seed was a decade ago. These rounds tend to be $1 to $3 million in nature, right? I write $500,000 to $1 million checks into these companies, and then there's a bunch of other people that come in, and we get to $2 or $2.5 million in total. And I think the way to look at it is less as like, here's how much money there is. It's like more like, okay, what type of bandwidth does that give me? And that first round, the $1 to $3 million round, it gives you the bandwidth to hire a couple of people, 2 or 3, let's say, amazing engineers, or whatever you need, maybe a salesperson, right? Whatever the business needs, and basically have a small team of like, let's say 5 people, right? And that's what really makes it into a company. And then you can actually start tracking against company goals. It's like, okay, are we going to get to $1 million of ARR next year? Sure. We got 5 people, put them against this problem. Let's get to $1 million of ARR. You can start operating like a tiny, small organization. That is what that round looks like. So, and we could keep going down the line, but I think for the listeners here, like the people in product that are thinking about maybe spinning out and opening up their own companies, think about it through that lens of like, am I already at the stage where I have a full team and I'm building, shipping to customers and all that? That's when I need VC money. That's when I go raise 1 to 3. If not, I'm still in the friends and family. I'm trying to prove, I'm trying to get design partners, I'm trying to put a demo together, get a few hundreds of thousands of dollars from angels, friends, bosses, whatever it is, and you're off to the races. And once you have that little bit of proof, then you can go on and get to pre-seed.
And have the expectations changed for what you need to see in like those, like given that building is a lot cheaper now, right? And you don't have to maybe hire 10 engineers. You could actually like maybe as a product person build the MVP that you can sell. Like what is the like the expectation? Like how have the expectations changed maybe in the last like 9 to 12 months or maybe 2 years, like on like what you want to see before investing in the pre-seed?
Changed a lot. I wrote a post about this. It went viral. Check it out. Talking in very tangible terms here, because I do a lot of B2B. So these like, products that you sell to enterprises, you sell to corporates so they can automate or do stuff better or replace humans in some cases. AI has that potential. I think we've went from just in the last 2 years since the introduction of generative AI and vibe coding and the ability to move so fast, right? We've went from like, oh, here's like a couple of great entrepreneurs like in a basement with an idea. Let's give them $3 million. I think now we've gotten to a point, especially in B2B, where if you're not showing up with at the minimum, design partners who signed up to get your product once you ship it and potentially pay for that, I think you're in trouble. And a lot of the deals that I see today at the pre-seed stage, they already have revenue because the team can build the product so quickly and just ship it and then go raise money, right? So it's the opposite of what used to be where we as VCs had to invest to get a product so we can get it out to the market. Now we're seeing more situations where the product is there. I mean, rudimentary product, but still delivers value, and you're already expected to have some revenue or at least some design partnerships built at the top of it. And the reason why that's happening in pre-seed is because the bar has moved significantly up at the seed and the Series A. So my seed companies now, companies that funded and are now going up to seed, they're expected to show up with, $500,000 of ARR, $1 million ARR. Heck, I have a company that just went from 0 to $1 million of ARR in 3 months. This is what they want to see at seed now, right? And the bar for Series A, oh gosh, even higher. You don't show up. It used to be, $1 million of ARR, you're ready for a Series A. Hell no. You better show up with $2-3 million of ARR, if not 5 now. So because vibe coding and product development has been so accelerated with this technology, it has pushed up the requirements in these different rounds in a very, very significant way. And here's the worst part. I don't think we're done. I think it's going to get harder and harder and harder.
I mean, it seems to me like the thing that's being evaluated to raise the money is like the same thing, but the reason the bar has gone up is because the difficulty of achieving a given milestone seems to be going down. So you're still looking for like, I want proof of conviction, I want proof of commitment, I want proof of hustle, right? So if all these things are available to you and you're not taking advantage of them, what does that signal to me about your level of commitment? What does that signal to me about your resourcefulness, about your ability to discern when you need capital? Because if you say you need capital to do something that you actually don't need capital to do,
You lose a point there.
you're focusing on the wrong thing. Like,
Right. And I'd add, you're absolutely right. I would add one more word to it, which is velocity, because now it's not just that you need less capital and less people to get something out there. You can also do it so much faster. So velocity has always been a key piece of startup success, but it's now even more extreme. This goes back to like, oh, you haven't gotten from $0 to $1 million of ARR in year one? Yeah, no, I've got 20 other companies who have. And that is, for a lot of top tier VCs, that's what we have. I mean, I'm like, when I go out to raise my next fund, I actually have a slide that says, here's 4 companies that went from 0 to multi-million-dollar ARR in a year or 2. And that's what people are looking for now. So yeah, the bar is so much higher with generative AI.
Yeah. And I think what that means is probably like, you have to be very, very, like, kind of back to your criteria. You have to be very intentional about the team that you assemble to start with, right? Because let's say you don't have anyone who can sell or like knows anything about distribution, you're not gonna do very well on that clock. Like the chances of you getting from 0 to 1 million, unless it's like an incredible product, right? That does the selling for itself, which is super hard to do, and it's gonna be really tricky to get there.
I mean, let me double down on that at a more philosophical level, because there's a much bigger point here. The bigger point is that this AI revolution is so freaking big, like bigger than anything we've seen before. And to move as fast as you're expected to move today, basically, if you hire people who don't know how to automate themselves, you're in trouble. Like you're now expecting the founders to hire vibe coders who can spit out code 5 times faster than what they used to do before. So a 3-people engineering team can launch a product in a month, guys, with this thing. 1, if you're a salesperson or an SDR and you don't know how to use the greatest tools and automate every single thing you've done more than once, you're also not being efficient, right? And you can just keep going. Customer support, what? You're still like going through tickets? Isn't AI doing 80% of your customer support tier 1 anyway? If you're not in that mindset, if you don't hire a team that has that mindset, I think you're just not going to move as fast as you're expected to move, and you're going to be in trouble. And what that creates, it creates a huge transition within the workforce. So I'll give you an example that I think is actually interesting for a lot of product managers as well on the technical side, right? I have CEO founders coming up to me all the time saying, yeah, we want to hire our first CTO. They're going to oversee all of engineering. It's great. And here's a guy who's seasoned. They've been an engineering manager and engineering leader for 20 years. And I go and I filter those people, right? I do a quick 30-minute meet the investor kind of thing. And whenever I see their mindset is not the right mindset of like, gosh, how can you automate? How do you add engineers that know how to use these tools to build so much faster and better? I just think they're not the best fit. You're probably better off hiring a 20-something-year-old who spent the last 3 years, 16 hours a day vibe coding and learning every single tool out there. Like, they haven't just tried Cursor once in their organization. They're not even thinking about developing without vibe coding as a starting point, right? I think that person in the future is actually going to be more effective for you than that 20-year seasoned CTO who hasn't really kind of jumped on the wagon of this latest and greatest tool. I mean, this is such a huge inflection point with how it build products that you just can't ignore it as a founder.
Yeah, it almost sounds like it's not just about having the right skill set, but also like having the meta skill set of knowing how to get leverage on your expertise. And this is actually really relevant too for existing product leaders as well, right? Like I think there's probably like some companies, like it's called incumbents, that it's probably going to take them, I mean, I don't want to predict here, but might get a couple of years to get to like a fully AI native where people are building agents, right? And, we have a lot of people that ask Ben and I, be like, hey, I have these 2 offers, either going back to, getting another product leadership role at an established company or joining as an ICPM at an AI native company. And it's a very personal decision for com, et cetera. But I'm like, if you want to be in the game for like at least like next 5 to 10 to 15 years, I would definitely go to the AI native company because like you're going to be,
This is one of the most important points professional career building here that would come out of this podcast. Super important. So here's something that I learned very, very early on. And I've been in tech for 25 years. And I got this advice very early on in my career. It's like, the advice was super simple. when you see that next big wave coming, and look, if you have doubts, if the wave is as big, that's a different thing. But I don't think anybody has doubts about AI at this point. I think we all got the memo, guys. Like, this is huge. Like, we've never seen anything this big, maybe since the invention of the personal computer or the internet, right? It's like at that scale. When you see that next wave coming, you jump on it, no matter what. Because in tech, you're only as good as your last job, as your last position. So if somebody asks me today, well, I'm a VC and I'm further along in my career, but let's say if I was a mid-level product manager and somebody would come to me and say, oh, why don't you become an IC PM at Anthropic? I would take that job every single day. I would quit my job immediately and take that job now, because you have to jump on the next wave. The sooner you get there, the more you'll make out of that wave and the more relevant you would be for any subsequent job you're going to have from here onwards. So that is my maybe best advice for people listening here doing product management. Figure out how you can jump on this AI wave. The sooner the better, or unfortunately, you might be left behind. And even if you take a downgrade on like title, get paid less, don't worry about it. Think about the long term. If you're in Anthropic today and you just lost $50K of compensation a year, you're gonna make so much back, so much more 5 years from now, because you're gonna land in the next job because you were at Anthropic, you were at OpenAI at the right time. You're just gonna be so much more valuable in the workforce afterwards.
And also the talent density and the benefits of being in a really talent dense place too, right? And all the people that you're going to meet, the engineers, the designers, like if you want to start your own company, you have a huge roster to choose from of people that already know how to work in a future company, right?
Damn, I'd go be a janitor at OpenAI if they let me.
Drive an M3 for them, yeah.
I think if they have a lens, if the product leader we're talking about doesn't just want to not be left behind from a skilling perspective, but maybe wants to have a line of sight towards starting their own thing at some point too, outside of learning the AI native ways of working, seems to me also like becoming that distribution, like learning how to talk to customers, learning how to sell. Like, would you agree that like in a world where building, like in your future scaping exercise that you did, imagining a world where like building anything is immediate and super easy, is selling like one of the most important differentiators between teams, between companies, like the ability to like...
It's always been, it's going to be that on steroids, because look, at the end of the day, people buy products from people, right? Especially in enterprise, especially in B2B. That's one piece. So sales is absolutely critical for those type of businesses. But just when you think about what founders do, I mean, they're just like selling all day long. You're selling to customers, you're selling to investors, you're selling to your team. It's like you're hiring people and you're trying to sell them on like this grand vision that you have. Sales is probably the number one leading indicator. Like sales capability is probably the leading indicator for founders' performance, especially the CEO founder, right? So this is very, very critical. And I think sales by itself is changing a lot, especially with Gen Zs. It's like Gen Zs, and I'm not one, so I'm just like trying to patch together what I'm hearing and I'm understanding from the audience is like, they don't trust brands as much. They go with individuals. That's why influencers are so successful. It's like, I want to, like specifically for me, because I'm a little bit of an influencer on LinkedIn, I get people pinging me, younger people saying, I want the check from you. I have Sequoia. I want the check from you because I read your stuff and you're genuine and I can look you in the eye. And this is the type of person that I want on my journey. So like, it's about the individual and it's about what you stand for versus the system, the machine, the brand that people used to buy from. It's like gone are the days that you just buy IBM to stay on the safe side. Now you want to buy from Ben because you believe in Ben, because you saw Ben on TikTok and he's awesome. And this is the person that you want to engage with. So I think sales is changing that way. It's changing from like brand driven, old school marketing perspective to like influencers and culture bearers, right? Who are like standing at the front and people are coming to them and saying, it's not a push, it's a pull. It's like, I want to buy from this guy.
What? Let's say like, I'm a product leader and I'm listening to this. I'm like, oh shit. Like I hear the word sales. I'm afraid because I never done it. I have like the wrong impression. I also don't have an audience. So like, what would be your advice? Would it be to just start writing more online, get yourself out there? Anything else that you would do to start building that muscle?
First of all, I slightly disagree on what you said. I think good product managers are absolutely good, amazing salespeople. They just sell internally, not externally. What is product management all about? Product management at the core is all about bringing all those different stakeholders on board with this product, right? And getting buy-ins from all of them so that they're excited to get their stuff done, right? And you do that, you have influence without control as well, which is how are you successful with having influence without control, without managing all those different departments? You do it because you're a great sales guy. You're just selling internally, not externally. So I think good product managers are good salespeople. They just don't necessarily have the basic blocking and tackling that an SDR or an account executive has because they've been doing sales for a very long time. And guess what? That's actually the easy part to learn. So going more specifically into how I would, if I was a product manager and I was thinking more about how do I become a CEO founder, let's say, which is a very classic journey from like product to CEO founder. I would try to be on as many outbound calls as I can with sales leaders, right? Sales, success, just join those calls. Everybody loves to see product there. You can always weigh in on the roadmap and what works and what doesn't. And obviously you've got more color in the product than the salespeople. So you can give that perspective to customers. Customers love it, right? So go out there, get out there, jump on sales calls, be that sort of help your salespeople succeed, and you'll learn from them in the process. That's the second thing is, as a product leader, product visionary, hopefully, yes, you do want to get out there. I think even though the world is flooded with content and pods, and everybody's got a pod, no pun intended here, like today, I think you're almost like expected to get out there. And if you're not, like, I'm not, this is not categorical. Like, I'm not saying this for everybody, but like, for example, when I look at CEO founder backgrounds and I can't find them having an online presence, then at least in some categories, that gives me pause. It's like, wait, you're not out there. You don't have thought leadership. You don't have a Substack. You're not on any pod. Like that's like, maybe it's okay, but a lot of people are expecting that. So you should at least check the checkbox, and it will both promote your career and it'll help you, be a more successful founder, right? By getting out there. So that's the second thing. The third thing I would say is, and this is important, this is where product people sometimes don't think about it enough. It's like, I don't see enough product people networking sufficiently. You should network the hell out of stuff, even as a product person. Even if you're focused internally, which most product people are focused internally, right? Product marketing managers are sometimes more outward facing, but product management traditionally is a little bit more internal. It doesn't mean that you shouldn't get yourself out there and like go to events, meet other product managers, meet other people, network, meet VCs, meet other founders, right? It's not just the way for you to get your next job. It's also the way for you to start a company, like building that network, that network through networking with folks. And I don't see enough product managers doing that.
Yeah, some people just go into the cave, I guess, when they have a full-time job and they just pop their head out every 4 or 5 years. And
that's a mistake.
That's a mistake. I think that might have worked in the past, but I don't know if it's going to work in the future.
Exactly.
I know we're coming up on time. So Marc, should we start wrapping? Yeah. So Itamar, there's so much more I want to talk about, but we don't have time. So first of all, thank you for doing this with us. And I hope it's been helpful to the audience. I'm sure they learned a lot. 2 final questions for you as we kind of wrap up the recording. First, we talked about your LinkedIn. Is that the best place for people to kind of follow what you're thinking about? Or is there anywhere else you would kind of send them? And 2, how could they potentially be helpful to you beyond just staying on top of what you're thinking about these days?
Yeah. So yes, LinkedIn and probably Twitter. LinkedIn is probably the best way to find me. There's only one Itamar Novick. So just search me up, you'll find me. I write almost daily about VC horror stories and startup anti-patterns, which is all the things that you might think are great ideas for your startup, but can actually ruin your startup. So just follow me on LinkedIn. That's the first thing. And then the second, in terms of helping me, look, what I love doing, and I do this for fun, surprisingly less for money, but more for fun because I love doing it, is supporting founders from the get-go, right? From the earliest stages. And it's not just about investing. It's about being there for them and helping them get to that next level. That's what I love doing. So obviously, if you're starting a company, right, and you think I should hear more about it, reach out. There's one caveat though. I really, really need you to get a warm introduction. This goes back to networking. Find a person that knows you and knows me sufficiently enough to say, hey, this person is great. You should talk to them, and I'll gladly take the call. I will hear the pitch. And my promise to you, dear listener, is I will try to find at least one way to help you on the journey, even if I don't invest.
Man, that's
a
probably
great
like my favorite answer to that question. And such a cool way to just like walk the walk and test it of like, hey, you need to have a warm introduction in order to get in touch with me. That's really cool.
Yeah, and we got introduced back in 2014 from a founder you were helping from Amir. So yeah, you've been doing this for a long time. I think you're definitely like the first person I think of when I think of someone who's just like knows exactly how to help early stage founders from your experience. So I'm glad. I hope some of them are listening to this because hey, if we can send a good deal your way,
I'd love to.
That'd be great.
What I'm here for, guys.
Amazing.
Awesome. All right. Well, I think that's a wrap. Thanks, Itamar.
Thanks, guys. Really appreciate it.